Hey everybody, Tim Lofton here with Matt Jawiziak, and we just wanted to get to you some information that I am sure you've been listening to on the news. But the first thing I need to tell you is that everything discussed today is not to be considered investment advice. All advice will be delivered by individual meetings, and all historical data presented today does not ensure future performance or returns. Thank you to our attorneys for letting us put that on here to get things started. But Matt, let's jump in here. So there's been a lot of news about bank failures. And I mean, I got to tell you, that sounds scary.
Yeah,
If you're just, flipping on the news and you hear about banks being literally taken over by, you know, that seems scary.
it's terrifying. It can
Yeah.
be, right?
Mhm.
It's just a lot of moving parts. I
Mhm.
mean, let's focus on Silicon Valley Bank. That's really what triggered everything.
Yeah.
So the big thing with
That's
Silicon
West
Valley,
Coast.
that is on the West
Silicon Valley,
Coast.
West Coast.
It's
Got it.
out there in
Okay.
San Francisco. Yeah.
Okay.
Also, wanted to caveat: what a week to take a vacation, right? And I come back, and I know my clients were talking to me, but a lot of fun happened while I was gone. But I do want to put a lot of things to rest about what is going on with this particular banking crisis. Okay. So the first thing that I really want to get to is this is not 2008, right? There's a lot of differences between now and what's going on in 2008. A
Because
lot of
there's
that
been comparisons. Like, I mean, people are
nonstop.
right comparing that this is like a 2008, and what I've heard from you is that this is nothing like 2008. It is somewhat of an isolated situation and kind of a perfect storm
Yeah,
that's
yeah.
come. Yeah.
Yeah, and so to unpack that, right?
Mm-hmm.
That's kind of the goal of this is to unpack that. So let's look into that. Why is this different? So you really got to isolate on how a bank operates, what they need to operate, and kind of how they function, right? So a bank in general takes in money, right? So I've got my paycheck, I go deposit it at the local bank, LCNB. Say it's $1,000, they take that $1,000 and they lend that out. Okay, they are allowed to lend on what is known as a fractional reserve banking ratio. Okay, lots of fancy words. Keep it simple for everything we're doing here. If they've got $1,000 and it's a 10-to-1 ratio, let's say that if they've got $1,000, they can lend out, call it 10,000, right? So 1,000 to 10,000. That means if they're lending out a million, they have to keep at least $100,000 of liquidity. So that's number one. Now, number two is if I give them, let's say, $1,000 again, right? They're incentivizing me to be a depositor. It's called a demand deposit account, right? And so if I'm going to LCMB or if I'm going to Huntington, what am I shopping for? What are they doing? They're giving me services or something along the lines. LCMB,
Ginsu knives.
they
The guy
can
who wants a free set of Ginsu knives or a
maybe
toaster. That went
potentially
showing my age a little bit.
before 2008. I don't know if those are allowed anymore. But bottom line is you'll go to a certain bank and they'll offer free checking or they'll offer our money market will grow at 0.25 or whatever. All that means to a bank is if I'm giving that bank money until they lend that out at that ratio, that is a cost center. It costs money for them to have these deposit accounts, right? So if a bank has $1 billion of people dropping money in there, that costs them money, assuming they haven't made any loans. Okay.
Right.
So understand those two things real quickly. Number one, 1 to 10 ratio or something along these lines to be able to lend out. Also understand that deposits are not expensive, but they are a cost for a bank. So what happened with Silicon Valley in particular? Now we're going to look at what type of depositors they have,
Because
right?
it's different type of people that
Wildly.
are working with that bank, right? I mean,
Absolutely.
this is your Silicon Valley
Yeah.
high flyer. So a lot of startups,
Yes.
companies that maybe are getting large sums of money
Yep.
from venture capitalists and that type of thing, but that money is not going to stay in the bank long term,
That's
right? Because
correct.
of just the overhead of a startup,
Right.
right?
So think if you are PayPal, for instance, or LinkedIn or anything like that. The bottom line is if when you create that company, you're going to get it. It's called Series A. It could go all the way up to just keep creating letters if they keep getting money. But let's say you get Series A funding and it's $100 million seed money to start your business. So you deposit $100 million into the bank, Silicon Valley. You've got payroll, you've got all these moving parts that are happening rapidly. So you could
Right.
deposit $100 million and very, very quickly the next week, I need 20 million ASAP, right? I've got a new
Right.
building that I'm purchasing. I've got something, some sort of capital expenditure. It's wildly different than if me, you, Tim, anybody, we deposit money in a bank and we might withdraw $5,000, or we might, if we're making a major purchase, we might pull out 40 or 50,000, but the ratios are in different levels.
Mm-hmm.
So keep all of that in mind, because Silicon Valley Bank focused, like as we mentioned before, they focused on these venture capitalists and startups, right? So once that, I think it was 2019 that they had roughly 60 or 70 billion. These are round numbers. You can look it up, but you'll understand the metrics once I get to it. Let's say they had 70, maybe 80 billion in assets that were, or demand deposit, checking, savings, right? They were so good at their job at marketing that they went from about 70 or 80 billion, shot up to almost 180 billion in a year and a half.
Wow.
Right? Keep in mind, pre-COVID, there was a lot of what we're calling free money or cheap money.
Right. Because during COVID, there was government money.
Right.
There was, interest rates were still super low. And so the ability to get loans and lending, even if you didn't need the money was so cheap. Why not?
Exactly.
Why not hang on to it?
Right. And venture capitalists work the exact same way. So, and that's where they're getting their funds from. So bottom line is, I'm a bank. I've got initially $80 billion of demand accounts. Okay. So let's go back to that 1 to 10 ratio. That means I'm lending out hopefully 800 billions in loans, right? Now, the idea behind that is they better be good loans. I can't just be giving anybody money. So they've got to be ultra secure and just safe. I had to vet. So if all of a sudden I go from 80 billion up to 180 billion, remember that these are expensive, not necessarily expensive, but they're cost centers for a bank. So the only way to recoup the money that I'm shelling out to keep that 180 billion is to get new loans. $100 billion means, at least on my ratio of 1 to 10, that's $1 trillion in potential lending.
Right.
And so if that happens very quickly, I've got to find somebody who's going to borrow potentially $1 trillion overnight.
Which isn't going to happen, right?
You can find a lot of people who take $1 trillion overnight. I don't know if they're all going to give it back. And that's kind of the scenario, right? You can't necessarily find a good lender,
right,
or a good borrower, I should say. So what that drove Silicon Valley Bank to do is purchase, I'm going to get a little bit too confusing here, but high quality liquidity assets. Okay. So FDIC says that's fine, or the Fed in general, I should say, says that's fine. I understand not everything is going to be just straight cash. You have to back this up. What are you going to do to keep assets coming in?
It's like treasuries.
Yeah, exactly.
Okay.
And so what they did is about 40% of their assets that they had to cover to become income producing, quote unquote, basically came in long-term treasuries. When I say long-term, I'm talking 10-year.
Okay. So they're not going short-term on these. They're kind of stretching that out.
Right.
In a low interest rate environment.
So
I see where this is going.
Extremely low interest rate.
I see where this is going. Okay.
Yeah. And so I think the critical error that the management piece did there was they bought too long of a term of assets. Now, so all of a sudden,
not knowing that interest rates were going to go up like they did.
Correct.
Right.
Especially not on this scale.
Yeah. I mean, because at that time, and we'd seen a couple decades of very slow or minimal change. And so this wasn't necessarily on their radar.
Correct.
Is that fair?
I don't think it was on anybody's radar.
Right. Okay.
Especially that it would happen this quickly. So you've got all these assets, and keep in mind, if I own something that is growing, or is the interest rate on it is 1% per year, and the interest rate of our standard interest rate moves up, this asset drops in value. Right. It's very simple. This stays fixed. This goes up. This is worth less. So
and now I'm upside down.
Now you're upside down. Now you own a negative asset.
Right.
Right. It's kind of like upside down on a car. It drops in value relative to when you bought it. You can own a negative asset when you get caught up in a loan there.
Okay.
So long story short here is, now let's go back to the depositors or the individuals who need their money. If you need to pull out 20 or 30 million, that demand ratio will drop down. Right. So I've loaned out, I don't know, a couple $100 billion, and I've packed up the rest of it with, let's call it $30-40 billion of treasuries, right? And that's all about because I've got $180 billion in demand accounts.
Right.
So my ratio is still good. Well, let's say these demand accounts are fluctuating rapidly and they're going down because it's been a tough economy.
Right.
And so these high growth startups are starting to lower their base. They need more cash.
Right.
Well, I've got to either increase something or decrease what I've got on the balance sheet on the other end to keep that ratio accurate.
And both are not good, right? If I've got to sell out of my treasuries and they're down in value, I'm taking potentially a loss.
The bottom line is everything is liquid. It just depends on what you're going to get for it,
Right.
right? So a truly liquid asset means you're going to keep value or you're going to sell it. So what happened was they had to take a lot of these bonds, flip them back over, recycle them. They still had a really good liquidity leverage ratio overall.
Okay.
It was a good decision how they actually went about it. The problem was they didn't tell everybody well. And when you've got a whole bunch of venture capitalist companies who need money on the dime very quickly, that news spreads rapidly out of control. And this was much more of a 1929 bank run.
Well, there was like a run on the bank. I mean, basically where everybody wants they want their money out.
And instead of waiting in line, you click the button and the money came out.
Gotcha.
And so that's what happened. It was Thursday, overnight, bank's gone, insolvent, and that happened.
So there was no line outside the bank. There
might have been one.
There was just people pushing buttons.
Yes.
Which is, obviously that wasn't even an option in 29, but I can imagine how quickly you can go from having a huge amount of reserves to no reserves to we got a problem. And that's kind of where we ended up, right? I mean, that's a little bit different story than what we're hearing on the news, though.
Right.
I mean, it sounds a lot more nefarious than just that kind of story. So that helps me.
Yeah.
And so what other areas? I mean, you had mentioned, I think, at some point that the government now is actually going to get involved with those treasuries. Why don't you talk a little bit about what that's going to look like?
Yeah. So I'm going to try to keep this simple. Again, everybody's heard of quantitative easing and quantitative tightening, a tight Fed and a loose Fed. Bottom line is when you're looking for liquidity in lending and in the banks and in the market, the federal bank will buy back all these treasury bonds to throw cash into the economy. When there's cash in the economy, things will grow. When they don't, they'll sell their bonds and basically take all the cash back in to try to keep the liquidity out. After this all happened, for one, the first thing, government stepped in and they said, depositors are fine. That has some outlying things. They're still trying to figure that out, but the company's not protected, right? No shareholders are protected, but if you had money there, we're going to take care of you.
Right. And that's the FDIC.
That's correct.
Right. $250,000
right.
of depositor monies is basically...
They went past that. They said everybody's safe, everybody's secure when it comes to Silicon Valley, and so that's a little bit of an oddity. The more important part here is the Fed has been tightening for the past year. We've all felt it. Interest rates have gone up. They've sold their bonds, and they're keeping cash back in. Well, they came out because even though Silicon Valley was leveraged incorrectly, in my opinion, that we've talked about, they probably had too much in treasuries. They've said all of these banks that exist out there have some sort of leverage ratio when it comes to treasuries on their balance sheets, right? But the thing is, they don't have 40 or 30 or 50%, and they don't have, I don't want to say crazy, but their depositors aren't individuals who are going to need millions and millions of dollars overnight. Right. So you get a couple things playing. The big thing that the Fed did, though, was they stepped out and they said, okay, fair enough, at least for the time being, until we get through this, any bank that has a treasury that might expire in 10 years, we will buy that back. We will honor that at par, which means there's no longer a negative balance attached to that.
Perfect.
So what does that mean down the road? Everybody knows. I'll probably be on another video with you guys here in a couple months. But the big takeaway here is liquidity as far as banks is overshot on the news. I really want people to understand that.
So I don't have to worry about, Fifth Third and U.S. Savings Bank and my local bank.
Right.
They're not impacted by this. This is a very specific situation in a very specific part of the country for a very specific type of depositor that we don't even really have in this area per se, or at least that's on a large scale.
Yeah, 100%. I think they estimated, so Tim brought this up earlier, that $250,000 is insured by the FDIC. Now that changed a little bit with these guys, but keep that as the baseline. Silicon Valley, I forget the number, and do not quote me on this, like 96 or 97% of their deposits were uninsured because they had so many individuals with so much money that it breached that $250,000 limit. So,
and I know, at least for us, I mean, we don't have very many people that keep $250,000 in cash.
No,
I mean, that's just not that's not the normal
That's
normal
correct.
person. I mean, this
Yeah.
is we're talking about large businesses
Yes.
and that type of clientele,
Yep.
which around our area is just different. And so, I mean, I think that helps a lot, Matt. Just understanding, because I think if you watch the news and get the idea that, hey, this could be widespread, I mean, I may feel led to go to the bank and get my money out,
Yeah.
right? And that's not what I'm hearing from you, and that certainly doesn't seem to be the case
No,
in our area for sure.
No, not at all.
Okay.
And again, even looking back on this, a week of retrospect, looking into Silicon Valley's balance sheet, it wasn't horrible. It just spooked a whole bunch of high value depositors, and they went very quickly.
Right.
Right. And so the only thing that really spooked the depositors has now been backfilled by the Fed. And so I see this as an overshot. I see the market kind of snapping a rubber band. It goes really fast. If you're watching a slow motion camera, it'll slow back down. So I'm not worried about it. I don't think you guys should be worried about it. If anything, this might trigger the Fed to slow the interest rates down, which would be fantastic. We've been talking about this. I brought this up last time.
Right.
We would love for them to slow and potentially bring it back down. But regardless, I hope this gives you a better understanding of where we're at.
Well, I think it does, Matt. And again, this is our gift to you. And the big takeaway from any of this information is, if you have a question about it, if you have that concern, don't let it keep you up at night. Pick up the phone and give us a call. That's what we're here for.
Yes.
And we want to be here with you. We want to partner with you. We want to continue to do life with you. And that's really what this relationship's all about. So thanks for tuning in. I hope this helped. I hope this kind of maybe pulled the curtains back a little bit on, what we're hearing on the news, put it in perspective, and hopefully leaves you guys in a better place. Until next time, this is Tim and Matt from Axum Planning and Wealth. We will see you next time on video or in the office. Have a great rest of your day, and we'll talk to you soon.
See you guys.